Hi folks, welcome to Oregon Cash Flow Pro. Now what we try to do here is to help you maximize your cash flow. Today I want to talk about how you can maximize the income that you receive. Specifically, we're going to talk about what you do with the cash that gets into your hand or right into your bank account immediately when it gets there. So when we talk about income, you end up with pre-tax dollars and post-tax dollars. What we want to talk about today is specifically income that ends up in your bank account. So typically post-tax dollars. Although for business owners have an even bigger advantage because they have access to pre-tax dollars before they become post-tax dollars. We'll try to address that either at the end of this video or in a future video. It depends on how long this one goes.
Oregon Cash Flow Pro offers free money management advice to help you take control of your finances. More wealth, less debt, fast. And now here's your host, personal finance enthusiast and licensed insurance broker, James Barber.
Okay, maximizing your income. When you get money, you work, doesn't matter what you do your job, you get paid. Now you have money, and this is post-tax dollars. So presumably you've already set aside money into your retirement accounts, your 401k, your 403bs, your IRAs, whatever that is. We're now dealing with post-tax dollars. That's what comes to you. And you might get it direct deposited into your account, you might get a check, you might get cash. Whatever the case may be, you now have money. What do you do with it? If it sits in your checking account, you're likely earning zero interest on it. You might be earning a little bit of interest on it, but it tends to be a very small amount. If you put that money right into your savings account, again, a very low opportunity for interest. And in both of those situations, you have immediate access to that cash. And as soon as you take that cash and you go spend it, it's gone. You no longer have the opportunity to earn interest on that money that you just spent. There's a third and a fourth option that I like to use in my personal life, and I'm going to share that with you. The third option is utilizing a line of credit to do offset accounting, or what I call dynamic banking. You get that money that comes into your account, and you immediately deposit all of that money into a line of credit, lowering the balance on that line of credit and offsetting 4, 5, 6, 7% interest for every day that money sits in that account until you need it again. And we specifically talk about doing this with a line of credit because you have access to those funds just like you would if it was a checking account or a savings account. You can access those funds immediately. So putting that money in there to offset the interest charges that you're currently paying saves you money right away, and you still have 100% access to those funds. This is what I do. I do that with a home equity line of credit, which has a 6.25% interest rate or so. So every single dollar that comes into my account, I immediately transfer it into my home equity line of credit, saving me 6% on every single dollar that comes in. So if I end up with income of $4,000 a month or $8,000 a month, that immediately lowers my home equity line of credit balance by $4,000 to $8,000 a month, which at 6% interest is probably around $30 or so each month. Not a whole lot, but that adds up over time. If I can put that $30 towards something else, I'm all the better for it. It really helps me to chew away and eat that debt down really quickly, maximizing my cash flow. The other option is using infinite banking with a whole life insurance policy. That is something else that I do in conjunction with the home equity line of credit. But you don't have to. Those can function separately. And I'm going to briefly explain how to do that. So if I get income, we know I have the opportunity to put it into the home equity line of credit and immediately offset up to 6% interest for me personally right now, 6.25% interest. I also have the opportunity to deposit that money right into my life insurance account, my cash value whole life insurance account. The reason that I like that option as well is I'm not just offsetting debt, I'm actually creating wealth with that account. When I deposit funds into that life insurance policy, it does a couple of things for me. It immediately increases my death benefit. So my legacy to my heirs goes up every time I put money into it. I'm guaranteed to get 4 to 6% interest growth every year, depending on dividends. I happen to be utilizing a whole life insurance policy from a mutual company, so the dividends are strong every year. So I have that guaranteed 4 to 6% interest. That money in there grows tax deferred, and I can access it at any time tax-free through a policy loan, meaning I borrow money against that policy. Now I can borrow money against that policy, and there's a few different ways to do it, but specifically with one of the companies that I really like to use, it's a 6% interest rate that I borrow money from, but the amount of cash value in the policy is guaranteed to go up by 6% as well. So it offsets the cost of my loan. It's often called a wash loan. So essentially, I can borrow money from that account, and the money that I borrowed against is still in that account earning 6% interest rate. It allows it to grow and compound without interruption. Remember when we talked about the savings and the checking account? If I pull money out of that, it stops. It has no opportunity for growth. That money gets spent. But if I do the same thing in the life insurance policy, that money will still continue to grow at 6%. And as long as I pay that loan back with the 6% interest, I'm still on that compounding growth curve. So it's an excellent way to make sure that my savings in that account is going to continue to go up year after year. The other thing to consider is when I have that money sitting in a checking or savings account, any interest I earn on that is going to be taxed that year. I get a 1099 from the IRS. So whatever that interest that I earned on that, it actually is reduced by whatever my tax rate is. 10, 12, 15, 25%, whatever. In the life insurance policy, I do not get any type of tax reduction. It goes up it grows tax deferred, and I can access it at any point tax free through the policy loans. So there's an incredible advantage there in that I get an immediate death benefit, which is multiple times the amount of money that I put into it, available to my heirs. So if I were to say let's say I get $5,000 in income, I deposit that in a savings account, and then I pass away the next day. My family has $5,000 that's going to get passed on to the heirs. If I put that $5,000 into a life insurance policy, that might increase the death benefit 3 or 4 times. So if I were to pass away the next day, my family or my heirs ends up with $15,000 or $20,000 in extra death benefit that they receive tax-free as that death benefit. So immediate advantages, increased death benefit, higher interest rate, and it's guaranteed. It's not tied to the stock market. It's not reliant on the FDIC or a bank. It's actually in a life insurance company, which traditionally life insurance companies have some of the strongest financials out there backing up those funds. Certainly more so than a bank. A life insurance company has to have a 1-to-1 ratio of reserves. So for every dollar you put into the life insurance company, they have to have $1 in reserves in order to pay out. Whereas a bank has a 10-to-1 reserve. So for every dollar you have holding in a bank, they can loan out $10. And they only need to keep a tenth of those dollars in their reserves. So do you know where a bank likes to keep their reserves? In a life insurance policy. There's billions of dollars out there in life insurance policies that banks use as their reserve account. So it's pretty fascinating when you learn about all of this stuff. But getting back to being able to maximize your dollars as they come in, the goal for me and my family is to get every single dollar that comes in funneled through that life insurance policy first. At that point, I can pull it out and use it as needed. So I'm going to get a little bit wonky here because I'm utilizing the home equity lines of credit and the life insurance policies to really maximize every single dollar that comes into my possession. And we do that by the money comes into my possession, I put it into the life insurance policy first. I immediately borrow that money back out from the policy and I put it into my home equity line of credit. So my life insurance policy, I borrow from that at 6%. My home equity line of credit, I get offset 6.25%. But at the same time, my balance inside my life insurance policy, my cash value grows at 6% on anything that I just borrowed. So I hope I didn't lose you there, and I'll do some more videos in the future where we can tie all of this together on a whiteboard. But I wanted to get this video out to you so you can start to think about it and let it churn around in your head, and you can think about, what is your dollars doing? How are you maximizing the use of every dollar that comes into your hands? And is there a way that you can improve that? If you have any questions about this, put them in the comment section below. I would be glad to answer it. If you would like me to do an analysis on your cash flow, there is a link that you can send me the information, and I'd be happy to make a video on it, and you'll have that to refer to. So that's it for today. Thank you all for watching. Go out and enjoy the weather.